Good morning. Today is Wednesday, May 6th, 2020. Welcome to the Market Commentators podcast, a weekly discussion of markets, economics, and all things investing, brought to you by the Milwaukee Company. In addition to watching the video version of our podcast on YouTube, you can now find an audio-only version of the Market Commentators on Spotify, on Libsyn, and we're adding more platforms every week, so we'll keep you posted as we roll out more. My name is Matt Salm. I'm an investment analyst with the Milwaukee Company. Joining me today is Andy Wilms, President and CEO of the Milwaukee Company, as well as Mike Wilms, Andy's cousin, who serves on our portfolio strategy and wealth management teams. As a reminder to listeners, nothing that we present on this podcast should be construed as investment advice. And with that, Andy and Mike, good morning.
Good morning, everyone.
Good morning, and sorry for walking over your introduction there. I thought you were going to pause introducing me.
No worries. So given that earnings season has started, Andy, do you want to give a recap of what we've seen in the markets the last week?
Well, we have had more companies report first quarter earnings, and we're seeing more about the impact of the virus on their businesses overall. The reports to date have been dismal, but I would say they haven't been devastating for most companies. There's obviously some that have had devastating reports, but by and large, they've fallen pretty much in line with what you would expect given the current state of affairs. Stocks started May with a sharp decline on Friday after recording its best April since 1987, or its best month, I should say, since 1987. Airline stocks took a real beating on Monday following Warren Buffett's comments last Saturday that Berkshire Hathaway had pulled its investments out of the nation's four largest airlines. And Mr. Buffett also advised investors not to bet against America, which I found to be quite a positive thing for him to say. And then on Tuesday, yesterday, the Dow Jones was up about 400 points at one point in time, but the major averages cut their gains in the final hour of trading when Federal Reserve Chairman Richard Clardia said that the economy may need even more fiscal and monetary support.
So what's your overall impression of the current state of the market?
Well, as you know, Matt, by nature, I guess I would like to consider myself an optimist. At least I've been told I am such. But it seems to me the markets may be looking toward the economic reopening and the gradual relaxation of social distancing rules prematurely. I think the economic recovery may take longer than Mr. Market expects because it's not going to be uniform. It'll proceed at different paces at different places. And I also think there's considerable uncertainty remaining as to the outlook of COVID-19's future course. I'm very optimistic, as people who have tuned into this podcast know, about some of the developments on the medical front. But those positive developments shouldn't be mistaken, in my mind, for a signal that we're out of the woods. I think that there's still a lot of uncertainty there, how this is all going to play out.
And I think that's right, Andy. I mean, if you go back to Warren Buffett's comments about don't bet against America, the entrepreneurial spirit that has been targeted on finding a treatment and vaccine for the virus is unprecedented. I think they've got 140 different candidates for a vaccine and an equally large number for potential treatments. But there's just a tremendous amount of uncertainty around this. Just about all of the companies that have reported their earnings to this point have pulled any kind of guidance on what to expect for the second quarter and the second half of 2020. So, it is pretty hard to get overly optimistic. But Matt, it was part of a conversation we had yesterday afternoon. If you look at where the S&P 500 is, it put in an all-time high in February. It had a very difficult March, but has retraced most of that drawdown and is off just 15% from the high back in February. That's a pretty amazing recovery given the uncertainty.
Well, and if you look at Warren Buffett said, "Don't bet against America," but at the same time, he hasn't made any big investments either. He said, I've yet to see something that was appealing to me, and he's sitting on wads and wads of cash. So he's obviously uncertain too, and he's taking the safer road right now.
Well, I think that the $49 billion write-down on their assets when they reported was the largest single loss in corporate history. So I mean that might lead to a certain amount of caution, wouldn't you think?
Yeah, I guess so.
But he does have 137 billion in cash, so
yeah.
I mean he's got money to put to work.
Yeah, that's exactly right. Hey, Matt, can you bring us up to date on what's going on with COVID-19?
Yeah, as you talked about, Andy, there's a lot of uncertainty and things are going to proceed in different places at different paces. I like that saying. It's a bit of a tongue twister. But as of the last week, a dozen states, maybe a few more, have started to loosen social distancing restrictions. And so that is simultaneously, I guess, a positive thing on the economic front, but it comes with more uncertainty about the future progression of the virus. So I think we'll be watching that closely to see how that plays out. And there are also, as you mentioned, over 140, I think, vaccine candidates out there. And there are a few different trackers trying to keep track of the main ones. We can post a link in the show notes for listeners who are curious to get more into the details on that. But at least 7 of the vaccines, I believe, are now in the stage of clinical trials. So being tested on humans, or at least phase 1 clinical trials, which is great because the only way that we're going to know if these are effective is if we test them. And so it's great that we're getting to that stage in the process.
You know, it's interesting that you're talking about, and I agree with you, by the way, that the risk of releasing social distancing standards have on the recurrence of the virus. But at the same time, you know, there was a lot of talk in the news, I'm sure you're both aware of it, about the catastrophe that was going to follow from Wisconsin's decision to proceed with its primaries. And that the absence of social distancing involved with people voting, and there's all this coverage of people standing close together in lines that were very long in Milwaukee. You know, no social distancing going on. And here we are several weeks after the primary was conducted, and there's been no noticeable spike in the outbreak of the virus in the Milwaukee area. So I'm not saying that means we should relax all social distancing standards, but I think that what they did there, you know, was sufficient to keep, obviously, you know, using hand sanitizer, trying to modify, you know, maintain some degree of social distancing, but yet not shutting down the entire voting process. Shows that you can perhaps, and the same experience, by the way, in Hong Kong, right? They don't have any social distancing at the present time, but they have hand sanitizer everywhere. Everybody's wearing a mask. They're doing a lot of precautionary things other than social distancing to keep the virus from spreading. And of course, it's the social distancing that has the greatest economic cost, which, as you guys both know, there's been a lot of debate of whether that economic cost has a higher human toll than the virus itself has, at least up to this point. So yeah. I think the the thought is that maybe social distancing can go to the wayside, but at the same time, then we need to do other things like face masks and hand sanitizers and all these other things that could take the substitute for strict social distancing and the closing of the economy.
Simply until there is a vaccine and there is a treatment. I mean, there is a end point to the need for the social distancing and the use of personal protective equipment, and the virus is probably going to be with us from now until the end of time, but it will be more of a controlled situation without the high risks that we have in today's environment.
Yeah. Now, Matt, I saw something recently in the news that there may be a more dangerous strain of the virus. Have you seen that it's maybe mutated to a more dangerous strain that came from Europe?
Yeah, I saw that there was a mutation, and this might be slightly more lethal and also more contagious than the original strain of the virus. Granted, I don't have the scientific knowledge to dive into the details on those papers, but it definitely highlights the risks associated, with this coronavirus, but also with flu pandemics in general. That the virus can mutate, after a month or two, or at any point in the process, and that is worrisome to people working on vaccines, and that they might solve a problem that could potentially then change, and the vaccine might work on one version.
And I think some of that mid-disease mutation has been one of the major problems that they've been trying to solve since we became aware of HIV.
What were you saying,
I was going to suggest we touch base now a little bit on the bond market and talk about what's going on there. Mike, do you have any updates for us on that?
Well, I mean, the bond market has returned to a little bit more normal level of function. If you're looking to sell bonds, there is a reasonable expectation to find someone to buy them, and not necessarily the Federal Reserve. There was a high degree of liquidity that reemerged when the Federal Reserve talked about starting to purchase some of the ETFs that own bonds and fixed income. And they haven't actually purchased any of the bond ETFs. I think they're targeting the potential of starting that program next week.
Yeah, they said on Monday they were going to be starting that next week, I think it is.
And I don't believe that they've actually been buying any of the new issue corporate bonds, but they do have approval to buy both bonds that were outstanding and then bonds that were newly issued. And just the impact of the Federal Reserve indicating that they would take the necessary actions allowed Boeing to come to market and raise $25 billion versus looking for $60 billion worth of rescue funding from Treasury and the Federal Reserve. So, I mean, the bond market is returning to a normal level of function. There is concern with the primary dealer community and the level of Treasury issuance in the second quarter this year. They're expecting the need to raise $3 trillion. And that's a huge increase over any other previous quarterly total.
Right.
And to the extent the way that a primary dealer functions, they would actually need to buy bonds for the firm's account in the event that they didn't have customers. And there's a high likelihood they're not going to have customers for a full $3 trillion worth of new issuance. So there could be some fixed income hiccups here in the midst of some of the Treasury auctions. Another interesting development relative to the size of the funding that needs to be raised, the Treasury will be issuing a 20-year bond for the first time in decades. They're going to do a $20 billion financing. There's a concern because if you go back to September, where they had issues with the repurchase agreement market and the liquidity and ability to for the primary dealers to have a large enough balance sheet capacity to own more treasuries, we could be going into a situation like that again. But you do have the Federal Reserve standing tall at its post. They're in a position if the public markets can't absorb the new issuance, it's a reasonable expectation the Fed will be able to stand up and buy any unsold bonds.
Yeah, I think that's the expectation. So one hand's issuing them and the other hand's buying them. It's very,
I wish I could do
that. That's not printing money, supposedly. Anyway.
That's funny, yeah. And I think one other thing we talked about was the fact that it makes some sense from a national debt perspective to issue longer term notes at a time like now when interest rates are so low, right? That the cost of debt service can go down.
There's been some fairly sophisticated fixed income experts that have advocated for the issuance of 50 or 100-year bonds. And the longer the bond's maturity, that has an attractiveness to somebody with long-dated liabilities, somebody like a pension plan or an insurance company. But they haven't. Several other foreign countries have issued 100-year bonds. The United States has not.
Back to Matt's point about how it makes sense to issue longer-term debt in a low interest rate environment. Adding to the logic is the fact that we are in a low inflation rate environment too, right? Because inflation basically degrades the amount of the bond. You pay back in the same number of dollars, the dollars are just worth less. So inflation is a very good thing for a bond issuer, and there's actually been some speculation that the federal central banks, even though their mandate is to limit inflation, it may get to the point where they have so much debt that they want to boost inflation just to in effect, reduce the amount of their debt that they have outstanding, or the economic equivalent of the amount of debt they have outstanding.
Well, we haven't seen a recent CPI that would encompass what's happened in the month of August, or excuse me, April. I'm all right letter, but wrong. But essentially right now, with the 10-year at 72 basis points and inflation at something less than 2%, you have negative real rates, which is great for an issuer. And as a comparative here with the change in short-term interest rates year over year, the total cost of debt service, the interest that was paid by the federal government on the total outstanding federal debt was $269.6 billion from October 1st to March 31st. And for that same time period in 2019, it was more than double that amount at $574.6 billion. So, I mean, if you can extend out your maturities and kind of lock in long-term interest rates when they're this low, it'll be hugely beneficial to the not only to the Treasury but to the taxpayer.
So on the topic of inflation, I think we might want to circle back a bit to portfolio management and the individual investor and why this is something they might pay attention to, in addition to the more esoteric topics like the national debt and whether or not we should issue 100-year bonds. So in last week's podcast, we discussed how diversified portfolios have underperformed or have struggled to keep pace with a portfolio that was concentrated in the S&P 500 and growth stocks, and a portfolio that was concentrated in long-term government bonds, because those have benefited the most from the fall in interest rates. But Andy, you also explained that you're still a proponent of diversification, correct?
Yeah, that's right. I am. For the long-term investor, definitely.
Yeah. So this week, I think a topic we'll tackle rather than diversification is focusing on something that we've addressed in our newsletter recently, which can be called, I guess, the demise of value stocks. And to begin with, can you briefly review the hallmarks of a value stock?
Well, sure. First of all, thanks for that shameless plug of our newsletter, which is available at our website, theMilwaukeeCompany.com, under our media tab. But more to your question, value stocks are typically the stocks of well-established companies that are currently out of favor, and as a result, at least on paper, appear to be a bargain. That's the characteristic. They look to be a bargain. They typically pay higher dividends and trade at lower price relative to their fundamentals. That is, their book value, their earnings, or their sales.
Okay. And how do value stocks compare to growth stocks?
Well, as the name implies, growth stocks are shares of companies whose future expectations are high and whose earnings and profits are expected to grow. So it's typically, fast-growing companies that invest most or all of their profits back into the company and therefore pay little or no dividends.
Okay. And has one group tended to outperform the other? Is there one that individual investors, should favor as an easy way to get higher returns?
Well, I guess that's a two-part question. First, is one outperform the other? That depends on your time frame. Over the longer term, value stocks have outperformed. But over the last 10 years or even more, which maybe many people consider longer term, but growth stocks have outperformed value stocks by a large margin. In fact, recently the value premium has experienced its worst drawdown in 20 years or more.
Okay. What are some causes of that drawdown as the worst it's been in 20 years?
Because historically, the value stocks have been in the financial and energy sectors. Those are the two biggest components. And the energy drag on value over the last 2 years has been monumental.
Well, and that's right. But there are other possible explanations that people
Absolutely.
offer. Some think that it's because, as Mike has pointed out, the economy has favored growth companies. The sectors that have outperformed had been favored by the current economy. Others say that it's behavioral. That is, investors have become overly optimistic about growth companies like the FANG stocks and too pessimistic about the outlook for value companies.
You don't get a whole lot of attention at a cocktail party talking about owning JP Morgan versus owning Facebook.
That's a good point. My take on it is a little bit different. I think perhaps the reason is you've seen value stocks underperform over the last 10 years or so is because inflation's been so low during that same time frame.
Can you give a little bit more detail on that?
Well, as we just talked about, value stocks typically have stronger current earnings and less debt than growth stocks, which are expected to have better future earnings and currently have more debt. So when inflation is high, the current earnings favored by value stocks are more valuable, relative to the future earnings promised by growth stocks. And likewise, when inflation is high, then the future earnings of the growth stocks are discounted to present value by the current inflation rate, which means they're less valuable than they would be in a low inflation environment like we have today. And then the other side of that is the debt service, right? I mean, if you have higher inflation, typically you have higher interest rates. And so when you have a lot of debt like a growth stock and interest rates go up, that makes servicing the debt more expensive.
Yeah. So I think that leads naturally to the question of, okay, do I want to invest in value stocks or growth stocks? What do you think inflation is going to look like in the future?
Well, there are two sides to that equation.
This one I want to hear.
The first one is that, we expect there to be greater inflation. And that's primarily because the government has poured more money into the economy at a faster rate than it has in the past 200 years. And, over the next year or so, the federal deficit could reach $4 trillion.
On an annual basis.
On an annual basis.
And it's aggregate something north of 25 trillion.
Yep, that's right. And it's reasonable to assume that by the spring of 2021, the quantity of money will have increased by as much as 15, and some are even predicting 20%. The whole global destabilization brought on by COVID-19 at the same time is likely to reduce in fewer goods being produced for some time. I mean, we've already seen U.S. GDP fall, and it's expected to fall greater. So when you combine the increase, in money in circulation, the velocity of money, you basically end up with more money chasing fewer goods, and that has historically always led to increased inflation.
That is truly an inflation recipe.
According to some.
According to some. And do you want to summarize part of the other side of the argument?
Well, I'll do my best, although I'm not a modern monetary theorist. I'm more of a classical Milton Friedman type of guy. But they argue that the world has changed and that the quantity of money does not matter all that much with respect to inflation, especially now, because demand, we're going to see a huge drop in demand. And so with falling demand, will offset the increase in money supply. I mean, price, being an intersection of supply and demand. If demand drops, there's going to be less demand for these goods. That should be lower. That should result in lower inflation, not higher. In fact, some are arguing that we're actually much greater risk of deflation, and they point to the fact that the velocity of money has really slowed.
If you saw that graph, I mean, you can pull that up on the St. Louis Fed's website.
Yeah,
it's sloped. It's amazing.
Yeah, so the fact that it's fallen so precipitously, and that's normally very deflation or indication you could have low inflation. The money's not circulating as fast.
Exactly.
And the other thing is, the third argument for low inflation or perhaps even deflation is the fact that the dollar is regarded as the world currency. And so even though we've been adding a lot to circulation, demand for the dollar has continued to be strong, very strong, stronger in the form of a crisis. And so as there's more demand for the dollar, the value of the dollar has continued to hold up and should hold up in the future, which means it'll be able to buy more goods, right? The more the dollar is worth, the lower inflation rate you should have.
Yeah, so I think that all makes sense.
That would be what I think the counter argument would be. If you ask me my personal view, which I know you were about to do, just assuming actually, but I think that probably we look at low inflation for the next year or two or three even, but that in the long run, demand will recover. And as soon as demand recovers, inflation will be, and GDP, production will improve. So I think we'll see increasing demand, economic output increase. I mean, technology has aided in that to a great deal. And so when those two eventually kick in, I think inflation will too. I can't tell you if that's going to be in 1 year or 2 years or 3 years, but in my view, it's most likely going to happen.
But there was an Egyptian billionaire that's calling for $100 a barrel oil in 18 months. So, I mean, if you start seeing recoveries in energy prices, demand comes back. And I think you'll be surprised at how quickly demand comes back from the consumer once the shackles are off from sheltering in place. The potential for inflation is going to be there with the huge increase in the money supply.
Yeah. So, there's arguments both ways. But if from an investor standpoint, in my view, I would take a cautious approach to the risk of inflation. I'd rather be a little more defensive and than offensive. In other words, play a little extra safe. We've done this for some time now by shortening the duration of our bond portfolio. That is in shortening the risk, the vulnerability to rising rates. Up to this point, that hasn't proven to be necessary. Inflation and interest have stayed low, but I'd rather be on the side of caution with something as dangerous as inflation.
And we've talked in previous podcasts as well about TIPS, Treasury inflation protected securities, as a good way to hedge against rising inflation. And then I think the other component to that we added with today's discussion is that increasing the allocation to value stocks could be a good way to be prepared to handle a environment of moderate or higher inflation.
Well, that's exactly right. In fact, the value stocks, I think, is a good observation on your part. And I think also just we may want to actually when things normalize. I wouldn't suggest doing this anytime in the immediate future, but your stocks are a better hedge against inflation than bonds, right? Because obviously the yield unless it's an inflation protected, adjusted bond, nominal bonds are much more vulnerable to inflation than stocks. Stocks actually have held up pretty well in prior periods of inflation. So at some point it may make sense, not today, but maybe at some point it makes sense to overweight equities a little more down the road.
Yeah. Mike, did you have anything else to add?
No, I think you guys have done a pretty good job covering the inflation front.
We'll take
Well,
it.
thank
Pretty
you, Mike.
good.
I'm having
that's high praise coming from you.
I'm having a weaker moment.
Okay. Well, thank you everybody for joining us today. If you are on Twitter, please consider following us on Twitter at the Milwaukee Co. You can also subscribe to our weekly newsletter. If you enjoy these discussions, you'll probably enjoy that. You can find it on our website, www.themilwaukeecompany.com. We also tweet about our newsletter.
Matt handles the Twitter feed, so we tweet about all kinds of crazy stuff, which is fun. I'm glad about it. I am.
We had some fun Star Wars tweets this week for May the 4th. It's good stuff. And if you enjoyed this podcast, please consider leaving a rating and a review wherever you listen, whether that's on Spotify or if you listen to us on YouTube, consider liking the video and leaving a comment with your thoughts. This will help other people find the podcast and find the show in the future. And then, as we talked about last week, if you have any questions about the material we discussed, or if you have ideas for other topics you would like us to discuss, please email us at firm@themilwaukeecompany.com, and we'd be happy to consider discussing those things in future podcasts. So with that, Andy and Mike, thank you so much for joining.
Thank you, Matt. Thank you very much. Mike, good to see you. Talk to you soon.
Gentlemen, it was a pleasure. So I'm off to do my community duty and deliver Meals on Wheels.
Oh, good for you. I hope you're not driving. All right. Take care, everybody. Bye-bye.
I'll see you guys later.
Have a good one.
Bye-bye.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.